In the conventional financial sector, insurance relies entirely on the architecture of risk transfer. An individual pays a premium, and in exchange, a corporate entity legally assumes the financial liability of a potential future catastrophe. The math sustaining this industry is highly calculated. The insurer produces a return only when the collected premiums and investment income exceed the incurred losses. This illustrates the conventional risk transfer flow, a structure impermissible under Islamic business axioms. The transaction is severed here because it relies on two prohibited elements: gharar, excessive uncertainty, and maisir, gambling. The policyholder wagers against their own future well-being. Within Islamic frameworks, ethical imperatives like justice, known as al-adl, are not post hoc compliance measures. They require a total dismantling of risk transfer systems in favor of shared responsibility. The Islamic alternative is takaful. Derived from an Arabic root meaning joint guarantee, it operates on the principles of ta'awun, mutual assistance, and tabaru, meaning donation. Takaful alters the core mechanic of the entire system. Instead of transferring personal risk to a corporate operator, participants distribute the risk collectively among themselves. They pool their resources to guarantee each other against defined losses. The managing entity in this system is bound by Amanah, or strict fiduciary responsibility. This structural law dictates that the operator acts solely as a trusted manager of the pool, preventing them from exploiting the participants' capital. To function at a commercial scale, this ethical integration is mathematically codified into three specific operational architectures: mudaraba, wakala, and wakala with waqf. For any of these models to succeed, they must engineer an organizational framework where moral accountability to the community and the generation of profit are structurally inseparable. The first operational framework is the mudaraba, or profit-sharing model. Here, participants provide the capital, and the takaful operator steps in specifically as the fund manager. This flowchart maps mudaraba. Contributions split into two mandatory buckets. The risk fund is the tabaru donation, strictly compensating members' losses. The investment fund generates returns. Operators take a percentage of profits as compensation, but investment losses fall entirely on the participant pool. To protect the system, mudaraba includes a strict failsafe. If the risk fund faces a deficit and cannot pay out claims, the operator is legally required to provide a qard hasan, an interest-free, benevolent loan to cover the shortfall. By isolating the donation pool from the investment pool, mudaraba eliminates the uncertainty of gharar while establishing a channel for the operator to generate an ethical, shared profit. As the industry matured, critics of the mudaraba model pointed out a vulnerability. Allowing operators to share in the surplus funds creates a potential conflict of interest, pulling focus away from the core mandate of pure mutual assistance. The structural solution is the wakala model. Here, the operator acts entirely as an agent or a delegated representative, rather than a profit-sharing partner. This wakala diagram removes the profit-sharing link. Instead, the operator extracts a fixed wakala fee, called an ujrar, straight from initial contributions for their administrative expertise. Therefore, any risk fund surplus follows a different path, returning entirely to the participants, completely bypassing the operator. Even with this fee-based structure, the operator retains the obligation of the qard hasan. If claims exceed the community's reserves, the operator must step in with an interest-free loan to stabilize the pool. Wakala structurally removes the profit motive. The operator has no financial incentive to deny legitimate claims, aligning their role purely as a steward of the community's assets. The most legally advanced iteration of this system takes the agency model and reinforces it with independent property law. This is wakala with waqf. A waqf is a legal endowment. It acts as a distinct foundation intended for charitable purposes, legally separate from both the corporate operator and the individual participants. This wakala with waqf chart integrates a fortified central waqf vault. Operating shareholders make a permanent, irrecoverable donation to establish this independent foundation. Participants pay their tabaru contributions into the vault for mutual protection. The operator manages the waqf and collects fees entirely outside the vault, By utilizing the waqf, the architecture places a legally impenetrable barrier between corporate profit extraction and the community's mutual protection fund. This split-screen comparison tracks the evolution of ethical finance mechanisms side by side: mudharaba, wakala, and wakala with waqfs. Across all three, the principle of Amanah, or trust, locks on to the operator. Their restricted access to the central capital mathematically enforces their fiduciary duty. The loops routing surplus back to the participants demonstrate adl, justice. Equitable treatment is hard-coded into the capital flow. The central pools operating on ta'awun, mutual assistance, ensure the total structural elimination of gambling and uncertainty. Takaful rebuilds the capital stack from the bedrock up. Replacing risk transfer with a community-owned safety net aligns every dollar with social solidarity. These precise operational frameworks have scaled rapidly, managing billions of dollars globally, with deep roots in economic hubs across the Middle East and Southeast Asia. Leadership in this sector is defined by the architectural ability to sustain ecosystems of mutual protection. It demonstrates that robust enterprise and ethical responsibility share the same mechanical foundation.